Let's go over chapter 6 today. So under traditional allocation, product cost is equal to direct material plus direct labor plus manufacturing overhead. Estimated total manufacturer overhead cost is the overhead application rate based on budgeted overhead cost and the budgeted level of activity. So let's look at this predetermined overhead rate. It's the estimated overhead cost divided by estimated activity based. So depend on the what kind of base it is, it could be either units or dollars. Let's look at an example. These are material and labor costs per unit for the three different recorders. So we have solo, band, orchestra. We have the per unit direct material cost for each recorder and direct labor cost per unit for each recorder. So we know the estimated annual overhead cost is $2.5 million. The estimated annual activity is 1.25 million direct labor hours. So we use the $2.5 million estimated overhead divided by the 1.2 million estimated direct labor hours. We get $2 per direct labor hour. That's our overhead rate per direct labor hour. So for each recorder, we have the direct labor hour per products times the overhead rate per direct labor hour that we just calculated. We get the overhead assigned per products. And then we have the number of units for each products. The overhead assigned per product divided by the number of units for each product, we get the overhead per unit for each product. So for solo, it's $5 overhead per unit. For band, it's $8 per unit. And for orchestra, it's $4 per unit. Now we can calculate the per unit product cost using traditional allocation method. So for each product, we already knew the direct material per unit, direct labor per unit, and we just calculate the overhead per unit. So we add these up, we get the cost per unit for each product. So now we can calculate gross profit per unit. We know the sale price for each product, like for solo, sale price is $20, and the cost per unit we just calculated is $18.50. So 20 minus $18.50, we get gross profit per unit of $1.50. So that's the same concept for band and orchestra. We use the sale price per unit minus the cost per unit, we get the gross profit per unit. This is the gross profit by product line using traditional allocation. So let's look at solo. The number of units sold is 150,000 units. The total sales is $3 million. So the cost of goods sold have three parts: direct material, direct labor, manufacturer overhead. So the total direct material is 525,000, direct labor is 1.5 million, and manufacturer overhead is 750,000. So you add these three up, you add direct labor, direct material, manufacturer overhead, we get the total cost of goods sold of $2,775,000. We use the $3 million sales minus the cost of goods sold of $2,775,000. We get the gross profit of $225,000. So same goes for band and orchestra. The total sales minus the cost of goods sold, which consists of three parts: direct labor, direct material, manufacturer overhead. So total sales minus the total cost of goods sold for each product, we get the gross profit for each product. Then in total, we just need to add these across. So that's the total gross profit for all the three products. So let's look at cost drivers. Cost driver is the reason a cost occurs. So in the labor-intensive environment, the direct labor hour or dollars are a driver of cost. In a machine-intensive environment, machine hours are the cost of drivers. So we need to know how to identify cost drivers. Let's look at some examples. For customer service, the potential cost of driver is number of product returns for customers. For cleaning equipment cost, that's the number of square feet. For marketing expense, the potential cost drivers are number of customer contacts. For office supplies, the potential cost driver could be number of employees. Green floral tape, the potential cost driver could be number of customer orders, and website maintenance expense, the potential cost driver could be number of customer online orders.